Silver news. Beware, silver price forecasts just showed something massive. Something just shifted in the silver market, and most people haven't noticed it yet. The forecasts are in, the numbers have been run, and what they're showing is not what Wall Street is telling you. Silver moved from $37 all the way to $120, then collapsed back down. And right now, it's sitting at $70, quietly, waiting. But here's what nobody is talking about. The next move in silver may not be a correction. It may be something far larger, far more serious than anything this market has seen before. And the warning signs are already here. Welcome to Currency Insight, the channel where we don't chase headlines, we read between them. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't cancel your morning newspaper after reading just the front page, would you? Of course not. So go ahead, hit that subscribe button right now, because what we cover here is the kind of information that takes years to learn, and we're handing it to you every single week. And one more thing before we begin. Drop a comment below and tell us, where in the world are you watching from today? We have viewers from across the globe, and we'd love to know which corner of the world you're calling home. Now, let's get into what the silver forecast just revealed, and why you need to pay very close attention. There is a metal sitting quietly in the market right now. It is not making front-page news. It is not trending on social media. But the people who understand money, the people who have studied markets for decades, they are watching it very carefully. That metal is silver, and what is happening to it right now is not an accident. To understand where silver is going, one must first understand where it has been. Not long ago, silver was trading at $37 an ounce. It was a number that most casual investors looked at and shrugged. Nothing exciting, nothing alarming, just silver, sitting there, doing what silver does. But then something changed. The markets began to move. Speculators began to enter. Money began flowing in from directions that the traditional silver community had never seen before. These were not long-term investors. These were not people who understood the history of precious metals or the role silver has played in protecting wealth for thousands of years. These were what analysts call travelers, people who move in and out of asset classes the way tourists move through a city. They arrive with excitement, they spend freely, and then, when something else catches their eye, they leave. And when the travelers arrived in the silver market, the price did something extraordinary. It ran. From $37, silver climbed. It pushed through $50, then $60, then $80. The momentum built. The headlines followed. More money came in, more travelers arrived. And at its peak, silver touched $120 an ounce. It was a number that stunned even the most experienced voices in the precious metals community. But here's the part that most people are not talking about. When the travelers left, they took the price with them. Silver did not hold at $120. It collapsed, and it collapsed hard. Today, silver is sitting at around $70 an ounce. That is nearly a 42% drop from its peak. Now, there are two ways to read that number. The first way is panic. Many retail investors saw $120, got excited, bought in near the top, and are now watching their investments sit nearly cut in half. For them, $70 feels like a disaster. The second way is far more interesting, because $70 silver, after everything that has happened in this economy, after all the money that has been printed, after all the debt that has been accumulated, is not a sign of weakness. It may be a sign of opportunity. But to understand that opportunity, one must understand something deeper, something that is not often discussed in mainstream financial media. The economy that exists on paper and the economy that exists in real life are two very different things. There is a concept that economists refer to as the K-shaped recovery. Imagine the letter K. The upper line goes up, the lower line goes down. That is exactly what happened to the American economy over the last several years. The top portion, the wealthy investors, the asset holders, the people with stock portfolios and real estate, they went up. Their wealth grew, their net worth expanded. On paper, things looked excellent. But the bottom portion, the other 90% of earners, the working families, the middle-income households, the young people just starting their financial lives, they went down. Their purchasing power shrunk. Their costs rose. Their full-time jobs disappeared. In just the last 12 months alone, the United States lost 600,000 full-time jobs. Not part-time positions, full-time jobs, gone. And yet, the markets kept climbing. The speculation kept growing. Leveraged ETFs multiplied. Even private companies like SpaceX now have 10 leveraged ETFs attached to them. The gap between the financial world and the real world has never been wider. This is the environment in which silver is now sitting at $70. Not because the world is stable, not because the economic risks have disappeared, but because the travelers have left and the fundamentals remain. The serious investors, the ones who do not chase headlines, the ones who study cycles and read economic signals carefully, they are not panicking at $70. They are watching, they are calculating, and some of them are quietly beginning to move. Because when an asset class gets discovered by speculators, then abandoned by speculators, what comes next is almost never nothing. What comes next is usually the real story. And for silver, that real story is only just beginning. Most people wait for the news to tell them what just happened. Serious investors read the signals before the news is written. Right now, in the silver market, the signals are speaking, and what they are saying should have every business-minded person sitting up straight in their chair. There is a room in Washington, D.C. that most people never think about. It has no windows facing the public. It holds no press conferences mid-session. And yet, every single decision made inside that room ripples through every market on Earth. That room belongs to the Federal Open Market Committee, the FOMC. 8 times a year, the most powerful monetary decision-makers in the world sit around a large oval table, and they argue. Not casually, not briefly. They argue for hours, over single words. A word that stays in the official statement, or a word that gets removed, can move billions of dollars in minutes. That is how precise this process is. That is how seriously the markets take every syllable that comes out of that room. And right now, the FOMC is operating under a new dynamic. A new Fed chair has entered the picture. And unlike his predecessor, this chair is younger. He is being watched for fresh thinking. Analysts are hoping he will look beyond the traditional metrics, beyond the numbers that have been quietly manipulated and mismeasured for years, and ask a more honest question. What is actually happening on the ground? Here is what is actually happening on the ground. The mainstream narrative says inflation is the big threat, that prices are going to surge, that the dollar is going to lose value rapidly, and that interest rates must stay high to fight this coming wave. That narrative is being repeated loudly, on television, on social media, on financial podcasts across the world. But serious analysts are asking a question that cuts through all that noise. If inflation is truly surging, who exactly is going to pay for it? Inflation does not exist in a vacuum. It requires buyers. It requires people with money in their pockets willing to pay higher prices. It requires purchasing power. And purchasing power is precisely what is disappearing. Wages are not growing at a pace that matches rising costs. Full-time employment is declining. Household budgets across America are stretched to their limits. Families are making impossible choices between essentials every single month. The disinflationary pressure in services, in discretionary spending, in wages, is real. It is measurable, and it is being largely ignored by the loudest voices in the room. This matters enormously for silver, because silver does not move in isolation. Silver moves in response to the broader economic environment. It responds to interest rate direction. It responds to the strength or weakness of the dollar. It responds to fear, uncertainty, and the loss of confidence in traditional financial systems. And right now, all of those factors are shifting simultaneously. Interest rate hikes are not coming. The pressure on household budgets is too severe. The labor market is too fragile. The new Fed leadership understands, or is beginning to understand, that squeezing an already stretched consumer further would not fight inflation. It would simply break what is left of the economic foundation holding things together. So rates will hold, or they will fall. And historically, when real interest rates fall or remain low, silver moves. Not because of speculation, not because of travelers chasing momentum, but because the fundamental case for holding a real, tangible, finite asset becomes impossible to argue against. There is something else the forecasts are showing. The speculative mania that pushed silver to $120 was not built on fundamentals. It was built on momentum, on leveraged bets, on the same kind of reckless financial behavior that has inflated bubbles across multiple asset classes simultaneously. That mania created a ceiling, but the correction that followed, the painful drop from $120 back to $70, that correction did something important. It removed the tourists. It shook out the weak hands. It sent the travelers to the next exciting thing, and it left behind the floor. A floor built not on speculation, but on genuine economic need. The need for a hedge, the need for protection, the need for something real, in a financial system that is becoming increasingly abstract, increasingly leveraged, and increasingly fragile. The forecasts are not showing panic. They are showing consolidation. And in the language of serious market analysis, consolidation before a major move is not a warning to run. It is a signal to pay very close attention. There is a number so large that most people cannot visualize it, not in their homes, not in their businesses, not in their daily lives. That number is $40 trillion, and it belongs entirely to the United States of America. $40 trillion in national debt. Write it out on paper and the zeros stretch across the page like a warning no one wants to read. But here is what makes that number truly dangerous. It is not just the debt itself. It is the cost of carrying that debt. Every single year, the United States government pays over $1 trillion simply in interest. Not reducing the debt, not building infrastructure, not funding schools or hospitals or defense programs. Just interest. $1 trillion. Gone. Before a single meaningful decision is made. To put that into perspective, $1 trillion is more than the entire GDP of most countries on Earth. It is a number that would have been considered catastrophic just 2 decades ago. Today, it is simply the annual bill, and it is growing. Now add to that picture the weight of military expenditure. Defense budgets are not shrinking. Global conflicts are not resolving. The geopolitical tensions that drive military spending higher are not cooling down. They are escalating. The Middle East remains unstable. Energy prices remain sensitive to every shift in that region. And every dollar spent on military commitments abroad is a dollar that deepens the hole that future generations will be asked to fill. This is the fiscal environment in which silver is being priced today. Not a stable environment. Not a controlled environment. A structurally stressed environment, held together by confidence, and confidence alone. Now here is where the conversation becomes truly serious. The word hyperinflation gets thrown around carelessly in financial media. People use it to frighten, to generate clicks, to sell newsletters. But real hyperinflation, the kind that destroys currencies and dismantles entire economies, does not arrive from outside a country. It is not imported. It is not caused by a foreign enemy or a global conspiracy. Real hyperinflation is always, without exception, a domestic decision. It comes from within. History has shown this repeatedly. Weimar Germany did not collapse because of foreign pressure alone. It collapsed because of the internal decision to print money without restraint, to pay obligations that could not otherwise be met. And the United States had a small but deeply revealing taste of this dynamic right after COVID hit. When the government made the decision to pay people to stay home, to send checks to households across the country, to essentially print money and distribute it as income replacement, something happened almost immediately. Inflation did not slowly creep upward. It skipped double digits overnight. The experiment lasted a relatively short period, and even that short period sent shockwaves through every grocery store, every gas station, every household budget in America. Now ask a more uncomfortable question. What happens if that experiment becomes permanent policy? This is not a hypothetical designed to frighten anyone. It is a structural risk that serious analysts are tracking with great care. The 2028 elections are approaching, and with them comes the very real possibility that economic pressure on the bottom 90% of earners, the people living at the lower line of that K-shaped economy, could drive a political shift toward universal basic income, toward modern monetary theory, toward any policy framework that promises relief through the one mechanism governments always reach for when they run out of answers: the printing press. If that shift happens, If Americans vote at the polls for a system that pays people not to work, not as a temporary emergency measure, but as a permanent economic model, then the inflation that people are currently debating on social media will no longer be a debate. It will be a reality. And silver, along with gold, along with every tangible finite asset that cannot be printed into existence, will reflect that reality in its price. The threat is not coming from outside America's borders. It is being quietly voted on, debated in policy rooms, and written into political platforms right now. The question is not whether serious investors understand this. The question is whether everyday people will understand it before it is too late to act. When the noise gets loudest, the smartest money gets quietest. That is not a coincidence. That is strategy. Right now, the silver market is sitting in a place that does not feel comfortable to most people. $70 an ounce after a peak of $120 feels like loss. It feels like missed opportunity. It feels like the market has moved on and left silver behind. But serious investors do not feel markets. They read them. And what they are reading right now, in the consolidation, in the correction, in the quiet that has followed the speculative storm, is not defeat. It is preparation. There is a principle that experienced investors understand deeply. Assets do not become valuable because everyone is excited about them. They become valuable because the underlying conditions that support them remain intact. And for silver, those conditions have not disappeared. They have strengthened. The debt is larger. The fiscal pressure is greater. The labor market is weaker. The purchasing power of the average household is thinner than it has been in decades. Every single one of those conditions is a fundamental argument for holding a real, tangible asset. Not a leveraged ETF, not a speculative position, not a momentum trade, a real asset, physical, finite, historically proven, silver. But serious investors are not putting everything into one position. That is not strategy. That is gambling. What the most careful and calculated voices in this space are recommending right now follows a disciplined two-track approach. The first track is income protection. In a market filled with speculation, filled with leveraged bets and inflated valuations, the single most important question any investor can ask is simple. Where is the income coming from? Not the paper gains, not the unrealized profits sitting in a brokerage account. Real income, reliable income. Income that continues to arrive regardless of what the broader market does on any given Tuesday morning. That means dividend-paying stocks, companies with strong balance sheets, businesses that have demonstrated, not promised, not projected, but demonstrated their ability to generate and distribute consistent returns to shareholders. Companies where the dividend is not at risk, where the business model is not dependent on cheap debt or speculative consumer behavior. That is the first track, protect the income. The second track is the hedge, and this is where silver enters the strategic picture, not as a speculation, but as a shield. After a correction of nearly 42% from its peak, silver is no longer priced for euphoria. It is priced for reality. And in a reality defined by $40 trillion in debt, structurally stretched household budgets, a labor market losing full-time jobs by the hundreds of thousands, and a political environment where inflationary policy is a genuine electoral possibility, a hedge is not optional. It is essential. The serious investor does not buy silver expecting it to double overnight. They buy silver understanding that the conditions which protect its value are not going away. They are compounding. For the young entrepreneur watching this today, for the business owner building something real in an uncertain environment, for the aspiring investor who is trying to understand how money actually works beyond what mainstream media explains, the message from this moment in the silver market is not complicated. Do not chase what already ran. Do not panic at what has corrected. Study the conditions. Protect your income. Build your hedge carefully and deliberately, because the investors who will look back at this period with clarity and confidence will not be the ones who reacted loudest. They will be the ones who understood earliest and moved with patience, with precision, and with purpose. Silver is not finished. The forecasts are not warning people away from it. They are warning people to pay attention before the next chapter writes itself without them.